record headline profits, but a closer look reveals a more complex story. Maynilad Water Services delivered a strong first half, with net income rising 14% to 8.51 billion pesos. Revenues edged up, underpinned by higher billed water volume and modest tariff increases. On the surface, the numbers look reassuring. Yet behind these gains, borrowing surged. Interest-bearing debt jumped nearly 12% in just 6 months, outpacing the growth of assets. Equity, meanwhile, barely budged. Maynilad is financing its expansion less from retained earnings, more from fresh loans. Why the shift? The answer lies in an aggressive infrastructure program. The company's capital spending expanded rapidly, driving service concession assets higher by 16.26 billion pesos. New loans from major banks fueled these investments, from water treatment plants to network rehabilitation projects vital for long-term service and regulatory compliance. This strategy promises future earnings and regulatory returns. But today, it tightens cash flow. Net cash outflows from operations widened sharply, draining 1.55 billion pesos in the first half. The main culprit: accounting rules classify long-lived infrastructure outlays as operating cash outflows, compressing headline cash flow despite resilient customer billing. Traditional free cash flow measures also turned negative, and cash reserves shrank by over 10%. The company continued to pay out high dividends, matching nearly all its earnings, leaving little retained to reinforce the balance sheet. Leverage ratios climbed. The company's gearing and liabilities to equity ratios increased, while liquidity slipped. Maynilad remains below its internal ceiling for debt, and unused funds from recent equity and bond offerings provide a buffer. But if spending and dividends remain elevated, greater reliance on borrowing may follow when these proceeds are spent. One accounting nuance: more interest costs moved onto the balance sheet, capitalized as part of asset values rather than immediately recorded as expense. This boosted reported profit for now, but these costs will eventually be amortized across future years. The investment rationale leans heavily on projects that drive future regulated returns, such as cutting water losses and expanding the network. Early progress shows promise, with water losses already reduced and operational efficiency up. But the scale of ongoing spending and the slow pace of cash generation raise a pivotal question: will regulatory decisions permit Maynilad to recover these investments and their financing costs through future tariffs? For investors, Maynilad's financials pose both opportunity and uncertainty. Asset growth could underpin long-term returns, but current expansion relies on debt and regulatory clarity has yet to come. Until cash flows turn positive and regulators validate these investments, sustainable growth remains a future promise, not a present guarantee.